Hi, this is Chuck Carnevale, and this video is going to take a look at ROST stores through the lens of Fast Graphs, the Fundamentals Analyzer software tool. This graph plots ROST stores' earnings per share since calendar year 1999, which are listed here at the bottom of the graph. You can see that earnings growth has been very consistent and has averaged over 17.1% per annum since calendar year 1999. Perhaps what's most interesting about this graph is you can see that ROST stores' earnings per share actually accelerated. The growth rate actually accelerated during and coming out of the Great Recession. I believe this earnings record really illustrates the recession-resistant nature of this extremely high-quality retailer. Earnings growth accelerated over 25.9% from the 17.1% longer-term average. In order to orient you to what you're looking at, let me explain what some of these lines are. This orange line is calculated using a P equals growth rate ratio because ROST stores has very high growth at over 17% a year. So the slope of this line would be 17%, and the PE ratio simultaneously, because we're using the P equals growth rate formula here, is also 17. So anywhere you would touch this orange line would represent a PE ratio of 17.1 for ROST store. The light blue shaded area shown on the graph represents the dividends that are paid out of the company's earnings. The green shaded area represents earnings, and what you can see by looking at it with this iteration is that dividends represent a very small portion of the total cumulative earnings. In other words, ROST stores has a low payout ratio. I contend that earnings drive market price, and there's no better example of that than ROST stores. I've added two additional lines to the graph. This is now a fully functioning fast graph. We have the blue line, which is actually a blended trimmed and blended PE, normal PE ratio, and all that is the computer attempting to find out what price earnings ratio the market has most commonly applied for whatever time period that's being measured. Here we're measuring 1999 up to current, into calendar year 2013. So that's 14 years of history plus the current year that we're in. The black line on the graph now is monthly closing stock prices, and what's remarkable about this is you can see how closely ROST store stock price has correlated to and tracked earnings over this time frame. This orange line would in essence represent what I would call the intrinsic value, or we like to call the true worth or fair value of the company. And you can see that when the price is touching that orange line, it's theoretically in fair value. When the price falls below the orange line, as it does on occasion, the stock price is trading below fair value. And of course, during periods where the price gets above the orange line, it would be trading above fair value. Perhaps what's most important about this earnings and price relationship is the idea that stock price really does track earnings, and you can vividly see and clearly see periods when the price is overvalued or undervalued relative to its earnings. As we saw in 2012, ROST stores share price did get overvalued, but it has now fallen to fair value. At the time this video was being recorded, ROST shares were down over 7%, trading in the mid $55 range. As you can see, on March 6th, they closed at $59.70. The PE as of yesterday's close was 16.8. The company has a 1.1% current dividend yield, only has 8% debt to capital, which indicates that it has a very healthy financial situation. As a result of its current price being below the orange line, I would argue that ROST stores is currently undervalued. And utilizing other valuation metrics, you can see that from a standpoint of a historical PE ratio, this is a relatively low normal PE ratio that ROST stores has traded at. And this graph shows price to sales, and we can see that with price to sales at 1.37, that's a reasonable price to sales ratio for the company based on its historical price to sales ratio. But the real proof is in the pudding, and the pudding is the performance that ROST has generated for shareholders historically. This performance report assumes you invested $1,000 in ROST on December 31st, 1998, or basically the first day of the graph that we showed earlier. That $1,000 would have grown to $12,129.25 by March 6th close. That would have turned $1,000 into over $12,000, which is approximately 10 times better than what you'd have earned with an equal investment in the S&P 500. Dividends, the dividend yield is currently low, but you can see that ROST has a history of raising their dividend every year, so that a $1,000 investment since 1998, or year-end 1998, would have thrown off $523 of cumulative dividends versus only $227 for the S&P 500. 19.2% capital appreciation based on price movement plus an additional 0.4% added to that based on dividends and cumulative dividends and the growth of those dividends over time. Ross Stores has clearly been an exemplary long-term holding, and I believe the company still has a bright future. The consensus of 31 analysts reporting to Standard & Poor's Capital IQ expect Ross to continue growing at 13.9%. Since this number is approximately half of what they've grown at over the last 5 years through and during the recession, I consider this number to be very plausible. If that were to occur, and Ross Stores would see its PE ratio fall to 15. The orange line in this forecast graph is calculated at a PE ratio of 15. That would generate a 12.3% long-term rate of return, including dividends. If it traded at its more normal PE ratios or higher PE ratios, the return could be even better. Consequently, I rate Ross Stores a buy at current levels. Remember, these graphs that I'm showing in this video are prior to the 7% drop that occurred on Thursday, March 7th, 2013.